Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Albert Einstein may or may not have actually said that. Historians debate it. But here's what nobody debates. The math behind it is so absurd, so counterintuitive, so genuinely offensive to the human brain's ability to process exponential growth that when most people see it laid out clearly for the first time, their reaction isn't excitement. It's anger. Anger that nobody showed them this sooner. So let me show you something. $200. That's it. $200 a month. That's roughly the cost of a slightly above average cell phone plan plus a couple of streaming services. It's one dinner out per week. It's the amount most people spend on things they can't quite remember buying by the end of the month. $200 a month invested consistently in a broad market index fund at the S&P 500's historical average return of 10.5% annually over 35 years does not become $84,000, which is what your brain probably calculated. It does not become 120,000. It does not become 200,000. It becomes 509,000. $509,000 from $200 a month, from less than $7 a day. And here's the part that should make you stop scrolling and actually pay attention. You only contributed $84,000 of your own money. The other $425,000, the majority, the overwhelming majority, came from a mathematical force that was working silently in the background the entire time, not from your labor, not from your discipline. From time the market did 84% of the work, you showed up with 16%. That ratio, that specific, almost insulting reversal of who does the work is what this entire video is about. And by the end of it, you are going to think about every dollar you spend differently than you did when you click play. My name is Slime Johnson. This is Slime's Wealth Academy. Let's go. If you're someone who looks at investing and thinks, I don't make enough to invest meaningfully, if you've convinced yourself that the amounts you could put away are too small to matter, that the real money is made by people with real money, that you'll start when you're in a better position, make sure you hit that subscribe button and give this video a thumbs up if it helps you out. Because today we are doing something different. We are not going to talk about investing in the abstract. We are going to watch it happen. Step by step, year by year, dollar by dollar, we are going to follow $200 a month through 35 years of compounding. And I'm going to show you exactly where the money comes from, exactly when the math starts to feel like something, and exactly why the people who wait until they're in a better position are making the most expensive mistake in personal finance. So stay with me because this one is going to change something. Part 1, the history lesson, the most expensively ever told. I want to take you back to 1970. The American middle class is at its historical peak. Union membership covers 27% of the workforce. The average manufacturing worker earns enough to support a family on a single income, buy a house, and retire with a pension. The financial system, from the worker's perspective, is relatively simple. You work for a company, the company saves for your retirement through a defined benefit pension, and at 65, you receive a monthly check for the rest of your life. You didn't need to understand compound interest. You didn't need to know what an index fund was. You didn't need to make investment decisions. The company did it for you, for better or worse. And then, between 1978 and 1982, something happened that changed every single one of those assumptions. And most American workers didn't notice until it was too late. In 1978, Congress passed the Revenue Act. Buried inside it was a small provision, Section 401(a), that allowed employees to defer a portion of their salary into a tax-advantaged investment account. It was originally designed as a supplement to pension plans, a nice little tax break for executives. What happened next was not planned. Ted Benner, a benefits consultant in Pennsylvania, read the 401(a) provision in 1980 and realized it could be used to create a completely portable, employee-funded retirement savings system. He pitched it. Companies loved it. Not because it was better for workers, but because it was cheaper for them. A 401(a) shifts the responsibility of funding retirement from the employer to the employee. It shifts the investment risks from the company to the worker. And it requires the worker to become, in effect, their own pension fund manager. Between 1980 and 2000, defined benefit pension coverage in the private sector collapsed from 38% of workers to 20%. By 2022, it was under 12%. The 401(a), designed as a supplement, had replaced the pension almost entirely. Here's what most people don't realize about what that shift actually meant. It meant that 150 million American workers, most of whom had never taken a finance class, never read an investment prospectus, and had no framework for understanding compound growth, were suddenly responsible for making the investment decisions that would determine the quality of their retirement. And nobody gave them the manual. The pension system, for all its flaws, had one thing right. It put professional investors in charge of making the money grow. The 401(a) system gave workers the account and said, you figure it out. The result? According to Vanguard's 2023 How America Saves report, the median 401 balance for Americans aged 55 to 64, the people within 10 years of retirement, is $87,571, not $500,000, not $300,000. $87,000. That is the cost of the most expensive lie ever told to the American worker. That financial education was something you could pick up on your own. That the system would somehow explain itself. That waiting until you understood investing better before you started was a reasonable plan. It was not a reasonable plan. It was a gap that cost millions of people their financial security. And this video exists to close that gap. Starting right now, part 2, the data, the year by year breakdown. Okay, here is where most financial videos fail. They tell you the end number $509,000 and expect that to be motivating. But the end number isn't what changes behavior. Understanding the journey is what changes behavior. So we're going to watch this happen. $200 a month, 10.5% annual return. Let's go year by year. Year 1, you've contributed $2,400. At 10.5%, your account earns $250 in returns. Total, 2,652. Your reaction, under a welcome. You could have earned that $250 by picking up one extra shift. The math doesn't feel like anything yet. Year 3, total contribution $70. Total account value 8,918. Market returns have added 718 above your contributions. It's real money, but you're still the primary engine. You're doing the work. The math is just along for the ride. Year 5, total contributions $12,000. Total account value 15,887. The market has now added $3,887 over 3 months of your own contributions in pure return. Something is starting to move. Slowly. Year 10, total contributions $24,000. Total account value 41,427. Here's where the first real shock lands. You put in $24,000. The account shows 41,427. The market added 17,427, more than you contributed in the last 7 years. The engine is warming up. Year 15, total contributions 36,000. Total account value 88,862. You have nearly 90,000. You contributed 36,000. The market added 52,862, almost triple your contributions. This is the tipping point. For the first time, the mathematical engine is visibly outworking you. Year 20, total contributions $48,000. Total account value $166,321. You put in $48,000. The account shows $166,321. The market added $118,320, 2.5 times your total lifetime contributions. You are at this point a minority stakeholder in your own wealth. The math owns the majority. Year 25, total contributions 6,000. Total account value 293,866, nearly 300,000 from 200 a month. You contributed $60,000. The market added 233,866. The ratio is now almost 4:1. For every dollar you put in over your lifetime, the market has added nearly 4. Year 30, total contributions $72,000. Total account value $496,584. You have contributed $72,000. The market has added $424,584. The ratio is nearly 6:1. Year 35, total contributions $84,000, $509,070. Final answer $509,070. You contributed $84,000 over 35 years. The market contributed $425,870. The market did 83.5% of the work. Now let me show you something that will genuinely rearrange your thinking. Look at the last 5 years of this journey, years 30 to 35. In those 5 years, the account grows from 496,000 to 509,870. Wait, that doesn't look right. Let me recalculate properly with continuous monthly contributions. At year 30, with monthly contributions of $200 at 10.5%, approximately 452,000. At year 35, approximately 509,000. That means in the last 5 years alone, years 30 through 35, the account grew by roughly $57,000. In the first 5 years, years 1 through 5, the account grew by $15,887. Same $200 a month, same 10.5%. But the growth in years 30-35 is nearly 4 times the growth in years 1-5. This is what exponential growth feels like when you're inside it. The early years look like nothing. The late years are adding more wealth per year than most people earn at their jobs. And the only difference between them is time. This is where it gets really interesting. And this is the part that should genuinely make you angry. The villain in this story isn't the market. The villain isn't your income. The villain is the people who wait. Let me show you what waiting costs. Specifically, if you start at 25 and invest $200 a month for 35 years to age 60, $509,000. If you start at 35 and invest $200 a month for 25 years to age 60, $245,000. If you start at 45 and invest $200 a month for 15 years to age 60, $88,000. Same $200, same fund, same return. The only variable is when you started. Starting at 25 versus 35, 1 decade of delay costs you $264,000. You didn't lose that money, you never made it. Because those early years, When the amounts are smallest and the progress feels most invisible, are the years doing the most structural work. The years that build the foundation, the later years compound on. 10 years of waiting, $264,000 gone, forever. That is the actual cost of I'll start when I'm in a better position. Part 3. The twist, the psychological trap. Here's what most people don't realize about why the I'll start later decision feels so rational in the moment. In 2012, behavioral economists Shlomo Benarzi and Richard Taylor published research on what they called present bias, the documented tendency of the human brain to dramatically overvalue immediate rewards relative to future ones. This isn't laziness, this isn't lack of discipline. It is a measurable neurological feature of how your prefrontal cortex processes time. The experiment that demonstrated this most clearly, people were asked whether they'd prefer $50 today or $100 in 2 years. Most people chose the $50, even though waiting 2 years for a 100% guaranteed return is a mathematically extraordinary deal. The present reward felt disproportionately large because the future reward felt abstract. This is exactly what happens when you see $200 a month leaving your checking account. Your brain registers the immediate concrete loss. $200 that could have been a dinner, a car payment, a weekend, with sharp clarity. The future gain, $425,000 in market returns 35 years from now, is so abstract, so distant, so difficult to emotionally process that it barely registers as real. This is why automating your investment transfer the day after payday isn't just a convenience tip. It is the single most important behavioral intervention in personal finance. When the money moves before you can see it in your checking account, the brain never registers the loss. You can't miss money that was never there to spend. Benarzi and Thaler designed a program called Save More Tomorrow, SMART, that addressed present bias by asking workers not to save more today, but to commit to increasing their savings rate with every future raise. The results were staggering. Participants increased their savings rate from 3.5% to 13.6% over 40 months, almost entirely through automatic escalation they had committed to in advance and never had to actively decide to do again. The lesson, the decision to invest isn't the hard part. Making that decision once, automating it, and never asking your present bias brain to approve it again, that is the entire game. And here's the other psychological trap that the $200 example exposes. Most people who tell themselves they'll invest when they have more money are operating under the assumption that the amounts matter more than the time. That investing $500 a month in 10 years is better than investing $200 a month now. Let me show you why that is mathematically one of the most expensive assumptions a person can make. Scenario A, start at 25. Invest $200 a month for 35 years. Result, 509,000. The scenario B, wait until 35. Invest $500 a month for 25 years. You're investing 2.5 times as much per month. Result, 612,000. Okay, scenario B wins. But here's the cost. Scenario B, you contributed 150,000 out of pocket. In scenario A, you contributed 84,000. Scenario B costs you 66,000 more of your own money just to end up $103,000 head. And that's the best case for waiting, with 2.5x the monthly contribution. Most people who say, I'll invest more later, don't 2.5x their monthly contribution. They increase it by $50 or $100. And in that case, they are permanently, irretrievably behind. Time is not neutral. Time is the most expensive resource in investing. Every year you wait is a year of compounding that cannot be bought back at any price. Part 4, the present day. What to do with this right now. Okay, enough history and math. Here's the map for what to do with this information today. And I do mean today, not this week, today. Step 1, open the account right now, today. The single most common reason people don't invest isn't lack of money, it's friction. The account isn't open, the transfer isn't set up, the form isn't filled out. And every day the account doesn't exist is a day the $200 isn't working. If you have access to a 401(n)(a) through your employer, go to your HR portal today and set up or increase your contribution. If your employer matches any percentage, say 3%, and you're not capturing that match, you are leaving free money on the table. An employer match of 3% on a $50,000 salary is $1,500 per year of additional investment that costs you nothing. That changes the $200 scenario dramatically. If you don't have a 401(a) or want to invest beyond it, open a Roth IRA. Fidelity, Schwab, and Vanguard all have no minimum Roth IRA accounts. A Roth IRA lets your investments grow tax-free. On $509,000 in gains, the difference between a taxable account and a Roth IRA can easily be $80,000 to $100,000 in tax savings over 35 years. The account is free. The tax savings are enormous. There is no reason not to have one. Step 2, automate the $200 before anything else. Set up an automatic transfer on the day after you're paid, not a reminder, not an intention. An automatic transfer. The amount moves before your checking account has time to make plans for it. Now, you might be thinking, Slime, I literally don't have an extra $200 to invest right now. And I hear you. So let me offer a reframe. What is $200 a month? It's $6.67 per day. It's the Netflix, Hulu, Disney Plus bundle with money left over. It's the daily coffee you're buying on the way to work. It's the subscriptions you haven't audited since 2022. It's the 40 per week in miscellaneous spending that disappears and you're never quite sure where it went. I'm not saying cancel everything you enjoy. I'm saying before you conclude that $200 isn't possible, do a 30-minute audit of your last 30 days of bank and credit card statements. Go line by line. Find the $200. Because in my experience, the $200 is almost always there. It's just currently allocated to something that doesn't compound. Step 3. If 200 isn't possible today, start with $50 right now. Here's the math on $50 a month over 35 years at 10%, approximately $127,000 from $21,000 in contributions. Still a 6:1 ratio, still mostly market returns. And here's what most people don't realize. The habit is worth more than the amount. A person who invests 50 a month for 5 years, much and then increases to $200 is building the behavioral infrastructure that makes $500 a month feel normal by the time they get there. A person who waits until they can afford $200 is fighting their own psychology every single month until they start. Start small, start automated. Increase the amount every 6 months by whatever you can manage. The compounding of the habit is as important as the compounding of the money. Step 4, don't touch it. This sounds obvious. It is not obvious when the market drops 20% and every financial news headline reads like the opening chapter of an apocalypse novel. Here's what Dalba's 2023 quantitative analysis of investor behavior found. The average equity fund investor earned 6.4% per year over the last 30 years. The S&P 500 returned 10.15% over the same period. The gap 3.75% per year is entirely explained by investor behavior. People buying high, selling low, timing the market, panicking during corrections and missing the recovery. On a 200 bond more investment, over 35 years, the difference between 6.4% investor returns and 10.5% market returns is the difference between $300,000 and $509,000. $200,000. Lost not to fees, not to bad investments, but to behavior. The account is not a weather report. You don't need to check it every day. Set it up, automate it, let it run. And when the market drops, and it will drop, remember that the drop is not a signal to exit. It is a sale. You are buying the same future returns at a discount. Part 5, the honest take. No hype, no doom look. I'm going to level with you because this channel runs on honesty and always has. The 10.5% historical average return is real. The S&P 500's 50-year track record is real. The $509,000 math is real. And it is also true that past performance does not guarantee future results. A phrase so overused it's become meaningless, but that doesn't make it wrong. Here's what's actually true about the current environment. The Shiller-Cape ratio, the inflation-adjusted price-to-earnings metric, is currently sitting at approximately 34 to 35 times earnings. The historical average is 17x. As I've said in multiple videos on this channel, this doesn't mean a crash is coming. But it does mean that forward returns over the next decade are likely to run below the historical average. Many credible analysts, including research affiliates and GMO, project 10-year forward S&P 500 returns in the range of 4% to 7% real, inflation adjusted. So let's recalculate your 200 smart scenario at 7% instead of 10.5%. Over 35 years, 7%. Approximately $313,000. That's still $229,000 in market returns on $84,000 of your own money. Still a 3.71 ratio. Still the market doing the majority of the work. Still more wealth than the median American household has in retirement. The math is less dramatic at 7%. The principle is identical. And here's the thing about building habits around $200 a month in a potentially lower return environment. Contribution rate matters more, not less. If returns are going to be 7% instead of 10.5%, the variable you can control, how much you contribute, becomes more important. This is not a reason to give up on the math. It's a reason to take your contribution rate more seriously. The honest play right now is also the same play it always is, with one addition. High yield savings accounts are currently paying 4.5% to 5%. If you don't have 3 to 6 months of emergency expenses in cash, build that buffer first. In a high yield savings account, earning real returns while it sits there. The emergency fund doesn't just protect you from life's unpredictability. It protects your investment account from forced liquidation at the worst possible time. The math only works if you stay in the market. Staying in the market is only possible if a car repair or a medical bill doesn't force you out of it. Emergency fund, automated investment, Roth IRA or 401a, don't touch it, increase the contribution every 6 months. That's the whole system. It's not complicated, it's just discipline. And the discipline, once automated, barely requires willpower at all. Here's what I need you to carry out of this video. $200 a month is not a small amount of money. It is not an insufficient amount. It is not a consolation prize for people who aren't wealthy enough to invest real money. $200 a month, given time, becomes something that most people spend their entire lives working toward and never reach. It becomes the definition of financial security. It becomes the account balance that changes how your brain operates, how you take career risks, how you sleep on Sunday nights. And here's the part that should sit it with you after you close this video. The $425,000 that the market contributed to that $509,000 account, that money was always there. It was always available. The market was always going to return approximately 10% per year on average. That wealth was on the table for every single person who opened an account and didn't touch it. The only question was who showed up to claim it. Most people didn't show up because they thought the amounts were too small. They thought the timeline was too long. They thought they needed to understand more before they started. They thought they'd be in a better position soon, and the math did not wait for them. Albert Einstein, or whoever actually said it, was right. Compound interest is the eighth wonder of the world, but it is a wonder that operates on a strict schedule. It does not offer extensions. It does not give partial credit for good intentions. It rewards presence and punishes absence with mathematical precision. You are present right now. You watch this video. You have the framework. The account isn't going to open itself. Go open it. If this video changed the way you think about $200 a month, hit the like button right now. It genuinely helps this channel reach the people who need this most. Subscribe to Slime's Wealth Academy if you're not already here. We drop financial education like this every week. No jargon, no gatekeeping, just the real mechanics of how money works and how regular people can use them.